And Amazon earnings out yesterday flexed a $3.2 billion profit for the first quarter. But the stock fell after a bleak outlook on cloud. Amazon CEO and CFO warned AWS growth could cool in the months ahead. Take a listen.
In AWS, what we're seeing is enterprises continuing to be cautious in their spending in this uncertain time. Customers are looking for ways to save money however they can right now.
As expected, customers continue to evaluate ways to optimize their cloud spending in response to these tough economic conditions in the first quarter. And we are seeing these optimizations continue into the second quarter, with April revenue growth rates about 500 basis points lower than what we saw in Q1. As a reminder, we're not trying to optimize for any one quarter or year. We're working to build customer relationships and a business that will outlast all of us.
And here to help break down the tech giant's strong performance is John Blackledge, TD Cowen Senior Equity Research Analyst. So, John, how significant is the commentary around cloud?
Yeah, it is, and it overshadowed what was actually a really good quarter, right? I mean, they beat 1Q results were better on revenue than consensus. Operating income was well ahead of where consensus was. And then the 2Q guide overall was also better. But then AWS, and interestingly, AWS in the first quarter with the 16% growth was actually better than what investors were looking for, which was kind of like low double-digit growth. But then, as you guys pointed out in the lead-in, the decel in April to 11% growth was, kind of was kind of bigger than what people were looking for. And then you had the stock reaction, which was initially off the print up 10%, and then now it's looking down 2%. And it was all really based on that comment of the 11% growth for AWS in April.
Hey, John, it's Julie here. Now that we have gotten not just AWS, but of course the other cloud giants and gotten their numbers, is there a sense here that AWS is losing the cloud war?
Let's talk about it. So Google Cloud reported they had a 4% decel in the first quarter. AWS had a 4% decel. I think Microsoft Azure, which I don't cover, Derek Wood covers it for us, was a little bit of a lower decel. AWS still the biggest. It is growing slower, but also off a bigger base than both Azure and Google Cloud. And I thought they were bullish on the customer pipeline being very robust. It's just more like kind of the macro is leading to kind of near term kind of optimizations in the IT budgets for their enterprise clients.
John, moving over to advertising, Andy Jassy talked about advertising trends and basically saying most people still need to shop and also highlighting machine learning. How significant do you think those comments were, especially regarding machine learning on the back of everything that we've heard about AI and machine learning?
Yeah, I thought he really, in the shareholder letter that he put out last week, and then last night on the call, he really leaned into Gen AI, and they haven't really, it's been Microsoft and Alphabet in that Gen AI discussion, and obviously OpenAI, but they leaned into that. And then on the advertising side, I mean, they had 23% advertising revenue growth. Look at some of the other big platforms. I mean, Google Search was up 2%. Reported, and Meta's growth, ad growth was 4%. Amazon Post 23%. Obviously, a much smaller base, but they're doing well. Obviously, their sellers are looking like they said. There is still consumer demand, and the ROIs are still good on Amazon from an advertising perspective. And you have this growth that is well exceeding mostly every big platform out there.
Yeah, I want to follow up on that ad business, actually, because is this sort of the secret weapon that not enough people are paying attention to for Amazon? My understanding is that margins are actually comparable or, another good area of margin besides AWS. I mean, what's the potential of this business?
It's very good. They don't break out the margins, right? So they give you AWS margins, but they don't give you the advertising margins. But I don't think, if the biggest part of Amazon's advertising business is sponsored products, which is basically search, right? And so we think it's similar, right, to both Alphabet and Amazon and Meta's margins. So yeah, that's one of the biggest drivers. So it's AWS and advertising are the big margin drivers for the company. And I think one of the bigger things outside of AWS revenue trajectory is kind of the rest of the biz losses coming down. What we noticed, like if you look in 2022, if you back out AWS and you back out advertising, call it at a 40% margin, the rest of the biz had 26 billion in losses. Pre-pandemic, it was more like 1 to 2 billion positive, and that was a result of many things. Growing the fulfillment network, doubling headcount, inflationary pressures, but that's starting to ease. And I think we saw that last night with the beat on op income in 1Q, and then the better than expected op income guide in 2Q. And part of that is based on, these efficiencies we're starting to see some efficiencies on fulfillment. And it's also helped by, like you're saying, by the advertising margin.
And speaking of efficiency and fulfillment, some of the commentary that was also talked about was progress in providing customers more one-day and same-day delivery. I mean, how significant is the build-out with fulfillment centers during the pandemic that Amazon did? How significant is it right now?
It's significant, right? They doubled their network. They basically have, they called out, they have a UPS, and they significantly expanded their last mile delivery, basically calling out that they have like UPS within Amazon now. And yeah, 26 million customers did same day delivery in the first quarter. That was up 50% year over year. The other thing that I think is important to note is that their unit growth was up 8%, but shipping cost growth was only up 2%. That was even better than the fourth quarter, where units were up 8% and shipping costs were up 4%. So these inflationary pressures are starting to ease. And by the way, the same day delivery, people just, the product conversion just ramps up if you offer faster delivery. So, we thought the retail business would be good from everything that we kind of heard during the quarter, and it was better than we thought. And in part because of the investments they made in fulfillment and transport the last couple of years.
John, as we see those efficiencies, it reminds me to talk to you about job cuts, right? We've seen, 27,000 jobs cut from Amazon, and this is something that we've really been asking across the industry. Is it done? Is there more to wring from the business over the course of the year? Right.
I think it's TBD. I think it's TBD. So if we think about the job cuts, so initially they said 10,000 last year, and then it was 18, and then after further reviews, then they cut 9,000 more. So it's a little bit unknown. You would think that it might be done, but a little bit TBD. It's the biggest cost containment review this company has ever done, and I think we're starting, like we saw with the margin beat and the better guide, we're starting to see it. But a great question, and I would think it's done, but certainly I think they'll keep reviewing, and then I think it'll depend on the macro, right? I mean, we heard from them on AWS that enterprises are optimizing because of macro, and so a little bit dependent on the macro as it relates to headcount.
And finally, something else I want to ask you about is the investments they've been making in healthcare, right? Which, if you look at the model of Whole Foods and how that's turned out, which is okay, I guess, I'm just curious, is healthcare going to fall into that category? How are you thinking of that in terms of their overall strategy and how fruitful it's going to be?
Yeah, it's early. I think they have a number of things going in healthcare. I think on Whole Foods, I think what they also said last night was listen, we want to get bigger in grocery and in store and increase the store footprint. And they said they think within the next year they might have a concept where they can materially expand the physical footprint for grocery. And we know the reason why they want to do that is that grocery is the most frequent buying opportunity or for the consumer. But to come back to healthcare, yeah, I mean, they have a number of things going. It's early, but as it relates to the next 1 or 2 years, probably not super meaningful in terms of numbers and for investors.
All right, so we'll have to keep an eye on it in these early days. John Blackledge, good to catch up with you. TD Cowen, Senior Equity Research Analyst. Thank you.